Hello everyone, welcome to the channel of Trigonometry. Today is April 15th, Wednesday. So today I am going to present to you my new trade thesis, which is the new bull market has already started. I just posted this article on my Patreon channel. Please feel free to subscribe to my Patreon channel, and this is a free article. You should be able to see it as a free member as well. I will be keep posting my new trade thesis and article on the Patreon website. My new trade thesis is that the new bull market has started. The Fed may cut interest rate sooner than most expect. The market knows something you don't. Most people are understandably confused right now. Even if a peace deal is reached, does that automatically erase the deep structural problems weighing on this economy? Right? We have the inflation, we have the private credit, we have the AI displacing human as workers. What about all these problems? A simple ceasefire will not simply resolve all of these problems. So the honest answer is no, not on its own. But what if the war ending is just one piece of a much larger puzzle that smart money has already solved? So going back to November 2023, one of the sharpest and most disorienting rallies in recent memory. At the time, nobody could explain it. The market was aggressively pricing in a Fed pivot weeks before Powell ever uttered a word publicly at December 2023 FOMC. The fingerprints were unmistakable. Thin volume, gap ups that never filled, and a relentless short squeeze that systematically punished every bear who tried to fade it. Sound familiar? Which is exactly what is happening right now in the past few weeks. The setup is strikingly similar. And yes, inflation is still elevated, and yes, the labor market remains nominally strong, but look closer at the March CPI and PPI data. While the headlines ran hot, the core figures came in surprisingly soft. The distinction matters enormously. Meanwhile, despite elevated energy prices, consumers are pulling back spending as the economy softens beneath the surface, and the peace deal on the horizon, oil price will follow, stripping away one of the last remaining arguments for keeping rates restrictive. The Fed calculus is quietly shifting. Consumer sentiment has hit record lows. The inflation risk is fading. What's left is a softening economy that demands a policy response. So this is the CPI data released on last Friday. As you can see, the core inflations is come in lower than expected at 0.2% versus 0.3% month over month and 2.6% year over year versus 2.7% expected. Even though you look at the headline number, month over month, and 0.9% is very, very high, and 3.3% year over year is also very, very high because of the high energy prices. But as we reach a peace deal, the energy price will eventually come down as long as they don't leak into the core inflation. And as of this moment, it has not. Some people may argue CPI will be delayed slightly because it takes time for the price increase to be slowly passed down to the consumer side. But if you look at the PPI data, so PPI usually is leading CPI because it's coming from the producer side. So if we look at the PPI month over month is 0.5% month over month versus 1.1% month over month. So market is clearly anticipating a much higher PPI month over month and year over year. The PPI year over year is coming at 4%, which is very high, but compared to the consensus of 4.6% is much lower. I think this number is much tolerable than people thought. And also, the PPI month over month is at surprisingly low, 0.1%. It's even lower than the previous month. And the consensus was 0.5%. So this is way, way lower. And year over year, 3.8, also lower than expected, 4.1%. So this is very, very interesting. Core PPI usually will reflect somewhat of a pricing pressure because it's from the producer side. I'm very surprised to see this 0.1%. I think this could be the final deciding factor for the Fed to cut interest rate. Because even as a relatively leading indicator of PPI, core PPI data, it's softer than expected. I think the other reason why we have softer PPI and CPI data is because the consumer sentiment is at very low level. From last week, Michigan consumer sentiment is at 47.6, which is, I believe, the lowest read in many years. I think this does one thing, which is the consumer is expecting the price is going up, but they're not going to bidding up the price because they're not spending as much, even though if you look at here, the inflation expectation is at 4.8%, which is very, very high. However, despite the high expectation for inflation, the consumer is not spending as much. If you look at the recent consumer spending data, it remains relatively flat. I think it has a lot of things to do with the current sentiment score and also the continuous layoff in the labor force and from the tech sector, and people are holding back on the spending. It's not driving the actual inflation because people have less spending power. So I think right now for the Fed, the softness in the labor market is a bigger problem than inflation, as we can see here from the core PPI. I think this number right here is the deciding factor for the Fed. So the next Fed FOMC is on, I believe, April 29th. There's a small chance, I believe, Fed could be starting to cut interest rate in this April meeting. I think right now no one is actually expecting a rate cut in April. We have an average of less than one interest rate cut in the entire 2026. But I think we can have multiple cuts in 2026, starting in April. Maybe I'm early, but I'm looking at the data here, and the Fed is looking at the same set of data. Someone always knew. And this feels like another classic asymmetric information moment, where the smart money armed with a read the crowd doesn't yet have, methodically squeezes the bear into submission, knowing the fundamental catalyst is coming. The low volume melt up, the unfilled gaps, the pain trade running higher. It is all consistent with the market front-running a Fed pivot before the public announcement. The next FOMC meeting is the moment of truth. What Powell says on April 29th will either confirm this thesis or expose it. Either way, the market is telling us something. The question is whether you are listening. Now we look at the major indices right now. So last week I drew these two boxes. I was expecting a little more consolidation down below. I thought this rally was not sustainable until I looked back in 2023. What happened in 2023? We were right around here. We have, starting in July, one pullback and bounce, and another pullback in September, bounce, and another pullback in October. We bottom at around 342, and then magic happens, a V-shaped recovery. There was no consolidation whatsoever down here, a straight V-shaped rally, like from this October 26th bottom to this March 21st top. This first period rally is 31% on QQQ. Just think about this. On the index level, 31% in 4 months. That is some crazy rally. You can easily imagine some stocks would be more than double or tripled from here. The initial rally, a lot of people don't know what happened. It was until, I believe, on this day, the Fed pivot, and you see the massive gap up right here, November 14th. I think this is where the public got the information where they know Fed is going to pivot, and you see this massive gap up. And even before that, you see gap up 1, 2, 3, 4. These 4 gaps are unfilled permanently, never being touched ever again. So even though most of the gap in the index level will get filled, but some of gap like this is due to asymmetric information that smart money already know before everybody else. These gap will not get filled. This gap got retested, but it is never filled, and it's a huge gap. I believe this is like a 2% gap up, which is very much like the current gap that we have right here. This is like another over 2% gap right here. I think at some point in April, probably we're already right here, and the Fed pivots, and then we'll get another gap up, gap and go. This will leave the bears in the dust. So right now I am fully bullish. Yesterday QQQ rallied almost another 2%, S&P 500 another 1.2%, semiconductors another 2%, software up 1%. Everything's rallying. So even though we could get a little pullback today, but the yesterday's breakout was so strong, I think any pullback today may be the last buying opportunity you can ever have in the next few weeks. I don't think we're going to pull back to test this gap. We maybe will have some consolidation near the top and waiting for the final information to come out regarding the Fed pivot and the peace deal. I don't think we get a big pullback like many people were anticipating. I think at this point, this is a short squeeze all the way. And adding to the fuel, we have CTA net short to cover all their short position and going net long, which is a huge catalyst that's going on right now. And on top of that, we have the new earnings coming out in April. I believe the new round of corporate buybacks window will start in the next couple weeks. So that would add another positive catalyst to the stock market overall. I think we could break all-time high. And other tell you can get from this move is that look at all this consolidation up here, like months of consolidations, and it's breaking through within days, like none of the resistance ever exists. This is very, very unusual, and we finally got a little more volume yesterday. And then at like previous week or so, we got very, very low volume. It's like a pure short squeeze. And this volume right here is basically a confirmation of a breakout, a solid breakout. I think right here to this 617 line is the line in the sand of resistance, and the QQQ with a gap up and a gap and go with volume. I think this is the confirmation right here. Even if you want to argue this is a dead cat bounce over here with no volume, now this is the confirmation volume right here. This is my breakout candle. And you look at SPY, very similar story, right? Months of distribution right up top and got breakaway candle like this. This is a super strong breakout with rising volume. That's the confirmation right here. I tried to short this rally and got stopped out, and I got my confirmation right here. I think this is the right trade. I can be wrong at times, but I know when I'm wrong. I know when to cut loss but not to double down. When there's a new thesis coming out, I do not stick with my bias. I think this is a clear signal to go long from here. I know for a lot of people, it's very difficult to chase right up here. Even after a small pullback, it's going to be difficult for a lot of people. Like for a lot of people, it's you wait for a deeper pullback to get up to the longs. But sometimes things can change so fast within days, and then if you don't make decision quick enough, you're gonna miss it. I think this is a very typical situation where smart money know something that most people don't, and then we got left in the dust wondering what happened. The Fed is going to pivot. The rate cut is coming sooner than most people are expecting. So if you are still not yet on this rally, any pullback today would be a good chance for you to get back onto this rally. And you're welcome to join my Discord channel and my Patreon channel. I share all my thoughts. And trades immediately when things change. I notify my members immediately so you don't miss rallies like this. If you're interested in joining my Patreon and Discord, please check the links in the description below. What do you think of the current market rally? Please leave your thoughts in the comment section below, and I'll see you next time. Bye.
Another Monday, green on the screen, feeling so serene. Leverage the assets, living the dream, a money machine. Blue chip vision, make the right decision with perfect precision. Yo, we own the street, can't accept defeat. This bull run is sweet.